Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am Pushpendra Mehta, and my guest for today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back to the Open Treasury podcast, Craig.
Push, it's good to be here again, and we'll probably have Jack back soon behind a microphone again, so we're looking forward to that too.
That's great news. This has been a busy week for global economies, finance, and treasury. This week's list of important articles is again oversized, and we have much to cover. We'll touch on the Canadian economy and its interest rate guidance, McDonald's leaving Russia after more than 30 years, the volatility in digital currency, working capital solution to simplify and accelerate supply chain financing, the U.S. Association for Financial Professionals expansion to the Middle East and Africa, and finally the 2022 NBFI survey report. You can find these articles in the show notes from this podcast or by looking them up on CTMfile. The first story, Craig, is about Canada's central bank taking the rare step of providing guidance on the path of interest rates as it aims to keep expectations anchored while it unwinds stimulus in an overheating economy. Some economists believe the strategy is a version of the forward guidance used during the pandemic and may not work as expected, and that the central bank should instead bring interest rates into the neutral state and then pause. What is your opinion on the matter, Greg?
This non-guidance guidance that the Central Bank of Canada is offering is becoming extremely consistent around the globe. It seems like all of the major economies, major central banks, certainly the top 10 seem to be making adjustments, moving off of 0 or 0.5% and moving up. And so Canada's doing it as well. This movement towards neutrality, that's a bit of a hope, but that's what they're focused on. And given how rare it is, based on your comments, indicative of trying to calm and create stability in the market.
The next story, Craig, is about McDonald's leaving Russia altogether after more than 30 years of operations in Russia. The humanitarian crisis caused by the war in Ukraine and the unpredictable operating environment precipitating it have led McDonald's to conclude that the continuation of the business in Russia is no longer sustainable, nor is it consistent with McDonald's values. That's what they've said in a statement. Craig, the reasons given by McDonald's, including a number of brands for ceasing operations in Russia, are varied. You have the overlapping set of factors at play, from taking a moral, political, or human stance to show support for Ukraine, to practical business-driven considerations like logistical, supply chain, and manufacturing difficulties, or rising cost and trading conditions. But there is another overarching aspect, which is reputation. The reputational risk of continuing business as usual in a country that, in the mind of these companies, is a war aggressor is considerable. Going into the future, Craig, do you think reputational risk will become an increasingly important characteristic of corporate treasury decision-making, particularly when there is an expectation that businesses should respond to societal crisis in a responsible way, going beyond purely financial gains?
Most organizations are pretty high on their reputational risk as they look to enter into new markets. Leaving or, abandoning some market that you've been in a long time requires a higher level of issue, reputational risk of instability, a volatile government that does things like invade a neighboring country with little pretext for it, right? The denazification or potential for NATO, and all of a sudden you're in a shooting war, an invasion. I know it creates a humanitarian issue, but that makes it very unstable to be in that environment. Just like companies operate well when they know what the rules are for taxation, for resources, stability of laws, That provides a good ground bed for success. But when you have instability, the rule of law is not kept, you have mercurial leaders or that create these conflicts, that creates an environment that's not good for organizations. And so whether it's a combination of reputational risk or a combination of this instability, oftentimes those two things go together. So I think we're going to continue to see this heightened level of, concern. I don't know that it's going to increase, but it certainly reached a tipping point to pull out. It's different to leave a country than to go into one. Right. You're going to want a little more stable when you go in, but when you have a lot of assets there, you've been in some location like McDonald's for, I don't know, they've been in there like 30 years or so. And so now they're pulling out. That's a big hit. And so it's harder to do that. But if you create an environment that's not conducive or safe for businesses, they're going to leave. Just like, a neighborhood that is unsafe, people will move.
You make a great point. The next section is about volatility. You mentioned the word volatile, but this is about digital currency volatility. The first story in this section is about Citi, BNY Mellon, and Wells Fargo jointly investing US $105 million in crypto trading firm Talos amid the volatility in digital assets. And the second story is about one of the world's biggest stablecoins, TerraUSD, aka UST, depegging, or shall we say losing its peg to the US dollar, sparking an alarm across the crypto community. In recent days, cracks have started to show in crypto assets during a period of heavy selling across the financial markets generally. Craig, do you have any safeguard or precautionary tips or suggestions to offer to the treasury community to manage the volatility in digital assets?
No, I really just have some opinions about it, and they're not supremely well informed. So people may want to zip past this to the next section. But I think a couple things you've heard me say, and I've been public about. Digital currencies, those that are not stable, those are not backed by a central government, have a limited size if they continue to operate more independently. And I've said that for many years because of the risk of crime, the challenges of terrorism and using funding for that. Since, certainly most of the Western countries and actually most countries want to control on currency because of crime, to know where, who's trading with whom and what's occurring. They're not going to let those get too large without providing some way of tracking or measuring. We've seen that in different countries. The U.S., for example, requires you to report your Bitcoin holdings. Many of the governments track distributed ledgers to see transactions, and you may not know who's trading initially, but you can see the exchange of information, and as they identify who's who based on reported transactions, you can build this network of what's happening. And so there's going to be control about that. And so that issue of the pure anonymity of it is becoming less in some instances. The movement to central bank digital currency still seems very promising. The use of stablecoins, where the value of the digital currency holds its value, always seem more promising. People move from the more volatile when they're sitting, they move to a more stable currency. But several of these stories, and a lot of what happened at the very end of last week, over the weekend, and into this week is, you've seen not only volatility in the value of things like Bitcoin. It wasn't too long ago where Bitcoin was well over $50,000 a coin to now it's, bouncing around 30. That's a significant amount of regular volatility, but stablecoin, what's the value of stablecoin is that the price is stable, that you're using digital currency, but you're not experiencing these giant whipsaws of up and down, more speculative in nature. In one of those articles, Bryn Solomon, who's, a member of a crypto trading firm, said, at this stage, I don't think the firms will have the risk appetite to support it. Algorithmic stables are a confidence game. Once confidence is lost, it's game over. And that's referring to some of the methods on the stable coin of, selling or buying to, keep supply and demand so it stays very close to $1. That broke in a number of stable coin scenarios recently. And that's going to create you think everything is stable and then it's not. and that kind of is a self-fulfilling prophecy. I don't know that things are a confidence game just because there's confidence in the full faith of whatever government who's issuing currency. That's a different story. The full faith in a algorithm or all those who might trade in a particular asset is very different, far more subject to volatility than you would with like a central bank digital currency. I think that's going to be pretty significant as we look forward. I think this might mark one of those areas where it shocked the stablecoin era. But at the same time, you brought up the other article about several banks, 3 very large banks, a couple $1 trillion banks, and BNY Mellon investing over $100 million into digital asset infrastructure. So that doesn't mean that this was a wrong investment. How do we hold our assets, particularly digital assets? So my comments are, this is fascinating. The instability is a problem in the areas when people or companies expect things to be stable. If you're purely speculation, that's not necessarily a problem.
And to your point, you mentioned central bank digital currencies. Does this mean that this is good news for central bank digital currency? And more than 90 to 100 countries are already on their way in terms of adoption, testing. Does this mean that this will result in another push for CBDCs?
There's a lot more people who could talk about this. We probably should have them on the Open Treasury podcast who might be more informed about that. But my initial view is that, yes, it's good for them because everyone who's concerned about the stability, who was leaning on stablecoins, whose confidence may be rocked by that now, would feel much more confidence in something backed by a central bank. And so that would be, yes, it's more favorable to it. No, in that concerns about digital currency may spill over and infect the entire market, that people are concerned across the board. And so they avoid the sector, not realizing there are some differences that really don't amount to much, but there are other differences that do matter. And it may just be caught up as we'll avoid that sector. Just like someone's like, hey, we're avoiding all real estate because commercial real estate got soft. You might avoid other aspects of it. So there's some yes and no, and I don't know how to balance those two out.
So Craig, moving forward, our next story is about a solution, working capital solution to speed up supply chain financing. So the Minneapolis-based US bank has signed a collaboration agreement with LiquidX, a trade finance fintech, to simplify and accelerate supply chain transactions between suppliers and buyers. In your opinion, what are the key benefits of this collaborative effort?
There's a couple, and there's this long history of people saying that fintech and banks, there's this big concern about disintermediation. We've heard that for so long. We don't hear about it as much now, and I think this is just another example of collaboration. You could call it co-opetition, but collaboration. What are banks really well known for? They have good customers. They have strong balance sheets. They can lend, and that is a massive, I don't want to call it weapon, but a tool that they have. Fintechs tend to be more nimble. They have great technology. They focus on there. They're not constrained by regulated industries like banks are. And yet when they come together and certain tech has reached a particular level, now there's a happy alliance. So, one of the top 10 banks in the US Bank is leveraging their massive balance sheet to support trade and using a very good fintech provider, LiquidX, to help with that. So one's primarily providing capital, one's providing primarily tech. I know that's oversimplifying it. This helps create lots of flexibility. It's the democratization of capital that someone making a payment, can keep their money if they want, but someone wanting to collect sooner on their receivable now has additional flexibility. This was not always possible. And it's no longer the zero-sum game or win, lose. If I extend my payments, you collect later. If I pay you sooner, I'm losing, but you get your money sooner. This allows the third party or the third parties to enter, someone with a technology tool and the ability to set these trades up, and another entity, US Bank in this case, who can provide capital. And so it allows that to de-link. So someone can collect sooner and someone can still pay at a later term. And then there's a financing vehicle. And so you've created more flexibility and more margin We've said this about supply chain financing. It's really now being opened up to many, many more companies through the use of tech. This is a really positive trend that's been happening for many years. This is another positive example of these type of alliances or partnerships.
Speaking about alliances and partnerships and positive news, the next story up for discussion is about the U.S. Association of Financial Professionals, or AFP, foray into Middle East and Africa. Craig, do you think this expansion is being done for brand building purposes, to provide thought leadership, expertise, advocacy for the treasury and finance community in that part of the world? Or are there some other reasons?
The real benefit of the AFP expanding is more and more trade activity. The role of treasury, the role of finance is increasingly global. And because it's increasingly global, there's other complexities. And, the AFP it went from the US and Canada, included Japan, Korea. So there's been a number of times when they've been expanding to bring in a broader global community. I think that strengthens the overall organization. I know there's a number of really good treasury groups, particularly in Europe, but many parts of the rest of the world don't have that type of association that provides that type of support and a clearinghouse. So I think there's probably lots of reasons for it, but this is really interesting and helpful, I think, for the industry that we're more global and the AFP becomes more global.
The next story to my mind is extremely important, and that is why I'd like to discuss this with you. This is about the 2022 Non-Banking Financial Institutions Survey. Kyriba and Strategic Treasurer partnered to produce the 2022 NBFI, or Non-Banking Financial Institutions Survey report. The NBFI survey asked over 40 questions and was taken by 70 plus chief financial officers, treasury and cash manager respondents. The survey shows NBFI's top 3 focus areas being security, compliance, and efficiency. According to the survey report, 66% of respondents ranked security and fraud prevention as their top priority. 45% rated compliance as the second highest priority, and 33% chose efficiency as the third. Craig, were you surprised by these priority rankings? And do you think treasurers should be very concerned about security and fraud prevention?
Yeah, thanks, Push, and thanks to Kyriba for underwriting this. This is very much an industry vertical. It's non-bank financial institutions. So it's financial institutions who aren't banks, like insurance companies or brokerages. So this is a very narrow niche and a group of organizations that are very intensive around certain areas of treasury. So to your question about, was I surprised by the prevalence of security and fraud prevention over some of the other areas, that was top. I guess we've seen security, fraud prevention as a top item on a number of our annual surveys happening. Given the NBFI space, so these financial institutions are intensive in treasury, I would expect it to be pretty high. I don't know if I expected it to be 2x efficiency. I mean, efficiency is always a key driver in every area, from AP to AR to treasury, particularly operational areas. To see it selected at double the pace, double the rate, for one of the top 2 items, that was probably more than I was expecting. I guess when you think about the level of fraud attempts and the fact that these companies have been targeted heavily, it does make sense that they're very, very attuned to security, preventing fraud, and they have a mindset, a risk management mindset. So as we think about that, that makes sense. And I guess the other part too is the idea that compliance sat in between these two at 45%. 45% of companies had picked compliance as one of their top 2 items. Compliance has always been a top issue for regulated businesses like most NBFIs. Fines, fees, reputational damage, some of the things that we talked about are key motivators. Yeah, so seeing that above efficiency made sense. And then seeing the severity on the security side above that, I think that fits into the general mindset. And that seems really reasonable given what these companies are confronting.
I have another question for you vis-a-vis the survey report. In the treasury and finance arena, measuring financial performance is of greatest significance and possibly, as expected, took the top spot in the metrics aspect of this survey. 2/3 or 66% of NBFIs trace various financial performance metrics. However, what caught me by surprise is that not even 3 out of 10 NBFIs or 28% measure staff professional development, given that employees are considered the most valuable asset of an organization and in this case are responsible for managing the top 3 focus areas, namely security, compliance, and efficiency. So why is it that staff professional development measurement is placed at the bottom of the measurement ranking in this survey? Is it because there is little correlation between staff development and success, or is it because measuring staff development is highly challenging? What do you think, Craig?
I think it's probably some of all of those reasons, Push. I mean, part of this is staff development is secondary in that you're going to see a problem in staff performance before you realize the underlying cause may be staff development. And I think for a long time, we've looked at staff development as largely the individual's responsibility, and then to a secondary extent, the organization to make sure people are cross-trained, trained and developing. That's become heightened by the number of changes technologically, changes in the workforce, and the rate of, adoption of technology, adoption of new services structures. It's a catch-up game. We tend to react to changes, and there is a significant need. We can share quite a bit of survey results that shows people are very concerned that their team is not catching up, not staying current, and can become made redundant by technology, can become skilled in areas that are being replaced with technology and at a greater rate of speed than they're picking up new, more exciting, more interesting tasks, or at least more interesting and more exciting to others. And this is a pretty big risk. I don't know if this is a wake-up call, but this is certainly, it's taking the gauge on where there's a problem. In fact, it's just over a quarter, and everyone is, or nearly everyone is indicating they have a great concern about that. People keeping up. They're excited about new technology, but they're also, a significant percentage are also concerned about it. That's a real significant opportunity that will be increasingly turn into a threat for those that don't adapt to this new reality, a faster paced change.
Great. Greg, finally, what is your choice for the biggest or most important story of the past week and why?
Push, I know you were going to ask that question. And I was debating some of it in my head. I really like the research on the NBFI survey. I think if anybody's in that industry, they're going to like it, but it's hard to pick that one because it's a narrow industry vertical. It's one I care about quite a bit, but some people are going to be like, I'm in manufacturing. Why does that matter? I think the biggest thing that's happened here really has to go to the volatility on digital currencies in the last week or so. That seems like a pretty significant change. The breakdown of some of the stable coins, I think that's a pretty big shock in an area that is, managing digital currency, digital coins. I think that's going to have a longer and deeper impact than some of these other ones. On the economy, we know that that's been a trend. On the working capital side, this is a ongoing positivity with LiquidX and US Bank. AFP's expansion is more of a continuing trend, but this change on the digital currency, the volatility, and the breaking on the stable coins, the breaking of that connection, I think that might be the bigger story.
Great. Craig, I'd beg to differ with you, while perhaps because I see it slightly differently. To me, the story about McDonald's exiting Russia and connecting it with the Yale study, where this Yale study mentions that there has been a voluntary exodus of almost 1,000 companies from Russia to some degree. That with McDonald's is a sign that more businesses are weighing reputation and financial risks, ability, and some important other factors, interest rate, currency risk fluctuations. That story, to my mind, was my story of the week because, maybe as a content creator, trying to see where is reputation risk now going to fit into risk management in the future, including issues like ESG for that matter. How will that play out in the future? Will this become even more important for corporate treasuries? So that's why I would like to, possibly dig into this story a little more detail and connect the dots with reputation risk. So which is why I would choose McDonald's exiting Russia, and that too after 30 years. So it's obviously not just, a write-off story.
So in North America and in US in particular, it seems like there's been a trend over a number of years of cancel culture, canceling people if they say something or do something that is deemed improper, whether it's been deemed improper for a week or a year. It could be a tweet you made or something along those lines. It seems like that's been very much in the news, like instantly you can't, now you can no longer work for whatever reason it may have come about. Maybe you did something bad, but is the McDonald's leaving? Is this part of a broader, a nation state cancel culture? If you go beyond a certain level, you make it untenable for not just the other nation states to deal with, but you make it so that no larger businesses want to be part of it because it's too much. You've attacked a neighboring country. You're just shelling and bombing countries. And it just makes it untenable to be there economically, reputation, et cetera. Is this what we're seeing as more of a cancel culture from a nation level? Is this what's happening?
I don't know, but I'm thinking that at that point, it may have happened in the past, you knew this better, but our corporations saying that financial gains are important, but societal concerns are going to be important. And our societal concerns now going to have some numbers around them vis-a-vis economics, risk, finance, treasury. And if that's the case, is there a new framework that will develop within this, or is there a new business model that will emerge, which is what I would, want to probe into, which is, and again, I'm no expert on this, but that's why I thought, I found this fascinating, that what is making, conglomerates, organizations, barring, organizations maybe in the pharmaceutical industry and a few others who have no other choice but to stay back. But for corporations, very wise people, seasoned treasury and finance professionals, number of them may be seeking advice from you. What do we do? Do we pull out or not? And consequences tomorrow for countries where part of the Paris Accord, for example, in global environment, and issues like that will come up. So the X country has not reduced its carbon emissions, for example. So what do we do? Do we stay in that country? Do we pull out? And, so it's going to affect a lot of industries. And, obviously all of them are integrated at some point in time. What does that do to even say globalization? Does it reverse it, as we are seeing in some cases, or maybe the trend with the supply chain crisis? So I'm trying to link some of these things. And, again, from a thinking perspective, I find it extremely fascinating that what made these 1,000 companies, when traditionally they have, or at least a lot of them would, think about profits. And in some cases, their employees also. Humanitarian angle, it's very easy to say we're going to pull out of a country. But there are employees, for no fault of theirs, who are a part of that world. So what do you do now? Where are they going to get, gainful employment? So that's why I find this extremely, extremely interesting, and my story of the week. Craig, as ever, a very insightful analysis. Always a pleasure talking to you. A big thank you to you and to our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.